Hello, welcome back to class. And today we'll be discussing about audit planning and risk assessment. Audit planning and risk assessment. As we go, we will understand client acceptance and engagement planning. We will also look into the application of risk assessment procedure. We will look into the determination of materiality and identification of risk of material misstatements. And lastly, we will develop an overall audit strategy and detailed audit plan. And this will be more effective in the course notes. And let's firstly look at the importance of audit planning. Why is planning really that matter? Why planning matters? The first thing is it actually forms the foundation for an efficient and effective audit. So if audit will be carried out, audit planning is very essential to create a foundation for an efficient and effective audit. Also, it enables a risk-based approach. It enables a risk-based approach focusing on efforts where risks are highest, and it also ensures appropriate resource allocation, timing, and direction. And lastly, it helps prevent misunderstanding with the clients through clear engagement terms. And the key phase to be covered under audit planning is the first is client acceptance and continuance. The second is engagement letter. The third, risk assessment, and lastly, we have the materiality determination and overall audit strategy and detailed plan. Let's look into the client acceptance and continuance. Client acceptance and continuance, and this is before saying yes. There are key considerations that need to be put in place. And when we talk about the aspect of new clients, for acceptance, there is need to access management integrity, that is doing a background check and also third-party inquiries. Also, there is need to understand the business, the industry, and reporting framework. There is need to evaluate firm competence, the resources, and independence. And lastly, there is need to look for red flags. That is frequent auditor changes, litigation, and aggressive reporting. And for existing claims, which deals with the continuance, there is need to reassess periodically the process, and also there is need to consider changes in client circumstances, the integrity and firm resources, and also there is need for decision making. At this decision making point, you need to either accept, decline, or resign. And then the ultimate safeguard is to decline or withdraw if risk cannot be managed. Looking at the engagement letter, it's actually formalizing the audit agreement. The engagement letter is a form of putting into a formal procedure the audit agreement. And the purpose of this is to document mutual understanding of terms, to prevent misunderstanding, and also to it's actually required by auditing standard. Engagement letter is required by auditing standards. And the key contents in engagement letter are the objectives and scope of the audit, responsibilities of audit versus management, the applicable financial reporting framework, the form of audit reports, fee arrangements and timing, management and acknowledgement of responsibilities. And it's actually a living document, and this means that it may be revised if circumstances changes. Looking at the risk assessment procedure, when we look into this, it's actually how auditors understand the entity and its environment. the risk assessment procedure helps the auditor to be able to understand the entity and its environment. And the four key procedures, we have four key procedures. The first is inquiry. And for this, you inquire of management, staff, governance, and internal audit. Another procedure, the next procedure is analytical procedure, which compares data, identify unusual trends. And we also have the observation and inspection, that is, the auditor visits sites, review documents, and trace transaction. And the last is engagement team discussion, where insights are being shared and there is an identification of risk. And the goal of this is to identify risk of material misstatements at the point of financial statement level, which is pervasive risk, and at the assertion level, it is with specific accounts or transactions. We have materiality in auditing. And when we talk about materiality, it's actually the information can be material if its omission or misstatement could influence users' economic decision, if it has the capability of influencing the economic decision making of users. And it has key levels. The first is the overall materiality, and this deals with marks misstatements that wouldn't affect fair presentation, that is like a 5% of profit before tax. And we also have the performance materiality, which sets lower, example 50 to 75% of overall, to catch aggregate error. And we have the qualitative factors, which can make small amounts material. The first is it affects compliance with debt covenants. It affects compliance with debt covenants, and also it marks fraud or illegal acts. And lastly, it influences management's bonuses. Looking at the identification and assessing of risk, this is actually a two-level. The risk assessment has two levels, and the first is the financial statement level risk, just like we said, and the assertion level risk. For the financial statement level risk, we talk about the pervasive risk affecting many areas. It's about the pervasive risk affecting many levels, and it also have weak control environment, and at this point management overrides, and it deals with going concern issues. It brings about going concern issues. And for assertion level risk, it's actually specific to classes of transactions, balances, and disclosures. And it's existence, completeness, accuracy, valuation right, presentation. It deals with existence, completeness, accuracy, valuation, risk, and presentation. An example of this is risk of overstated revenue, and another is risk of understatement liability, which deals with completeness. And looking at it, the significant risk actually require special attention, and these include the complex or non-routine transactions, high estimation uncertainty, fraud risk, and lastly, related party. Looking at the overall audit strategy and detailed audit plan, it's actually, when we talk about the overall audit strategy, it deals with high-level direction, and for this, it encapsulates the scope, the timing, the reporting objective, the resource allocation in terms of team, specialist, and location, and then the decision to actually test control, whether to test control, use analytics, or rely on internal audits. And as per the detailed audit plan, it actually deals with the specific actions, and further audit procedure at assertion level are to test of controls if relying on control, and they are as per the substantive procedure to testing of details and analytical aspect. And for the detailed audit also, it specified the nature, the timing, and extent of procedure, and it assigns responsibility. And lastly, as per the dynamic process, it's updated as risk change during. And a case study of this is the tech grow that it's elaborated in the notes, and we have a scenario whereby for the company, it's actually a private tech company, experiencing rapid growth with about 60% revenue rise, and the planning IPO is in 2 years, and it's a small finance team. It has a small finance team and CEO dominated. The new revenue recognition standard is adopted, and the related party list with there is a related party list with the CEO's spouse. And looking at it, in planning this, you need to look at the client acceptance, and for this you need to look at the management integrity, the firm tech audit competence, and as per the risk area, there is need to look at the revenue recognition, the capitalized software cost, and the related party transaction. And as per the materiality, which is another consideration under planning, you need to look at it based on profit before tax, whether it's based on profit before tax, also considering the qualitative IPO. And for the risk identification for tech growth, this can be identified. The 3 identified risks are the financial statement level risk, which shows a weak control environment due to small finance team and CEO dominance. Another is the assertion level risk 1, which deals with the revenue. That's overstatement of revenue, risk of aggressive recognition before IPO, and lastly, assertion level risk 2, which deals with the software cost. And this is actually an inappropriate capitalization of development cost versus expenses. And why is this significant is IPO pressure is one, and another is complex accounting new standard, and lastly, estimation judgment. This makes the risk to be. We have materiality in auditing. And when we talk about materiality, it's actually the information can be material if its omission or misstatement could influence users' economic decision, if it has the capability of influencing the economic decision making of users, and it has skill levels. The first is the overall materiality, and this deals with marks. In conclusion, planning is proactive, not a box-ticking exercise, and risk assessment drives the audit, and materiality is both quantitative and qualitative. The client's assessment and engagement letter set clear expectation, and audit strategy and plan must be flexible and updated as new information arise. This planning output guides the all subsequent audit work and evidence gathering, testing, and reporting. Thank you.